So I've spent the past few days going through all of Tom Lee's latest interviews, research notes, and market commentary, and I've condensed everything he says into one clean argument, so you don't have to sit through hours of content. And just to be clear, today we're only looking at his macro and stock market outlooks. I'm not touching the crypto stuff. That'll be a separate video. In 20 seconds, here's his entire macro pitch. 1. The soft landing already happened. 2. Inflation is falling faster than consensus. 3. The Fed is done and near pivoting. 4. Liquidity is about to improve. 5. AI is the generational earning engine. 6. Investors are positioned too defensively. And 7. So US equities still have major upside. And that's the whole framework. These are the companies I've covered on the channel, the dates the videos went out, and how the price has moved since. Some winners, some losers. I want to be fully transparent. I'm not here to sell you a course or tell you what to buy. I just want to share my research I'm doing so you can decide for yourself. If you want these discussions showing up on your newsfeed, please do feel free to subscribe. All right, so now that you've seen Tom's roadmap and the context behind his targets, let's break down each part properly, because some of this holds up under real data and some of it unfortunately doesn't. So Tom's first claim is that a soft landing is basically done. The economy threaded the needle. Labor is cooling without collapsing. Productivity is rising, and earnings never fell apart. And honestly, this is actually the strongest part of his entire thesis. If you look at job openings, wage growth, and productivity, this is what a textbook soft landing looks like. The nuance he skips is that the strength isn't evenly distributed. Manufacturing and small businesses and part of the consumer economy are clearly slowing. So yes, the soft landing signals are real, they're just not universal. Next, Tom argues inflation is melting, but here's what the data actually shows. CPI and PCE have eased from their peaks, goods inflation is negative, supply chains have normalized, but real-time measures like Truflation have actually been rising and are now back at around 2.5%. So yes, inflation is much lower than last year, but it's not melting, it's stabilizing. And in the case of real-time data, actually drifting slightly higher again. That distinction matters because Tom's framework depends on accelerating disinflation, feeding into earlier rate cuts and easing liquidity. And right now, I'm not too sure if the data is actually moving in that direction. Tom's third argument is that the Fed is about to start easing more aggressively than the market expects. And yes, the Fed is cutting in 2 days. The real question now is how far do they go and how fast do they get there? And this is where Tom's conviction looks a little stretched because further cuts depend on inflation continuing to glide lower, and real-time data like Truflation has actually been ticking higher like I've just shown. That doesn't mean inflation is surging, but it means disinflation isn't clean. And the Fed's not going to accelerate cuts if inflation is stalling or drifting sideways. So yes, policy is easing, but the pace of easing Tom is implying requires inflation to behave perfectly. And right now, the data doesn't give a green light. Liquidity is about to improve. This is the heart of his model, a liquidity wave lifting equities. And there is some truth to it. QT is slowing, bill issuance helps, and the falling volatility has eased financial conditions. But the leap he makes is the issue. Liquidity hasn't expanded in a meaningful way, it simply hasn't just stopped tightening. We're not seeing rising bank reserves, accelerating private liquidity flows, or a strong uptick in net liquidity. Tom treats stability as if it's expansion, which is actually a pretty big difference. Now the next argument, the fifth argument he makes, is AI will drive a decade of earnings growth. So he basically sees AI as a new industrial revolution driving productivity, margins and earnings. And long term he's right, in my opinion. AI is a genuine multi-year capex cycle, but right now AI is a cost cycle, not a profit cycle. We're seeing massive capex, heavy depreciation, cloud margin pressure, and real bottlenecks around power and cooling, and the payoff will come later. Tom is compressing this timeline a little bit too aggressively. And if you want a deeper breakdown of this, by the way, I've done several videos on AI infrastructure, depreciation curves, power constraint, the economics behind GPUs. So feel free to check out those videos after this. Tom's next claim is that investors don't believe the rally, and that pessimism fuels the upside. And yes, institutional positioning is cautious, but the picture is mixed. Mega cap tech exposure is extremely crowded, retail enthusiasm for AI is back, hedge fund net exposure isn't at rock bottom anymore. So it's not a deeply bearish market, it's a bit of a split market. Cautious institutions, crowded mega caps, but not the clean contrarian setup Tom is implying here. And finally, his bullish S&P target. All of the assumptions we discovered flow directly into this output. Are his upside scenarios possible? Sure, but they rely on a long chain of conditions lining up perfectly. Smooth disinflation, expanding liquidity, broader market earning acceleration, fast AI productivity gains, and healthier sector participation. All of those are plausible, none of them are guaranteed. And here's the real question. Is the level of conviction behind those targets justified? Because at the end of the day, none of us actually know where the S&P will finish. So while the direction of his thesis might end up being right, the confidence behind the targets is where things start to feel a little stretched. I actually think Tom gets direction broadly right. Liquidity is no longer tightening, and AI really is a long duration investment cycle that will reshape earnings over the next decade. But where I disagree is the slope of the story. Tom is projecting a very fast, very clean acceleration in macro data, and that's not what the current mechanics support. Inflation isn't melting anymore. Real-time data management like Truflation has actually been ticking back up. Liquidity is stabilized, but it's not surging. And AI at this stage is still cost cycle. Heavy capex, heavy depreciation, and the payoffs come later, not immediately. The broader economy is more uneven than his narrative suggests. Part of consumer and smaller business sides are clearly slowing, and non-AI sectors aren't seeing the same strength as the mega cap leaders, of course. So yes, I'm constructive, but I'm not buying the parabolic version of the story. There are too many conditional steps inside the framework, and they all have to go right at the same time for the S&P targets to play out exactly as he's implying. So yeah, the upside is real, but the path looks a bit messy. And honestly, that's fine. Markets don't move in a straight line. They usually grind higher, they hesitate, and they overshoot and then recalibrate, right? This phase of the cycle requires nuance, not certainty. So anyway, the thing is with Tom Lee is that he's built a brand based on being the optimist, where everyone else is basically frozen. And there's value in that. Markets often reward people that see the turn early. But as investors, we can't outsource conviction to anyone. We need to separate what's supported by data from what's powered by narrative momentum. Some parts of Tom's thesis are legitimate strengths, and others, in my opinion, get a little ahead of the mechanics. And that's the nuance people miss, I think. So I'd love to hear your thoughts. Is Tom early or bold this time, or is the story running ahead of fundamentals? Do feel free to drop a comment. I actually read and reply to all of them. If you found this breakdown useful, feel free to subscribe. Thank you so much for watching, and I'll see you in the next video.